Financial Freedom Show. My name is Rob Berger, and I don't know, I'm glad that it's Monday at 7 p.m. Hopefully, at least one or two of you are as well. As always, if you can hear and see me, give me a thumbs up. I'd appreciate it. So tonight's, I answer your questions. Going to talk just briefly about Warren Buffett and Bitcoin. He says he wouldn't buy all the Bitcoin in the world for $25. What? We're going to talk about that briefly, and then I'll jump in and answer your questions. I see the thumbs up, James. Now, if you've watched the show before, I'm using this Restream thing, right? That Restream is just a tool, but one of the things it allows me to do is like put your comments up on the screen like that. Unfortunately, what it doesn't do is show me all of the great comments and questions you've asked before the show started. However, I've got another screen here. Actually, I can show it to you. That's what it looks like. So I see all these comments over here that you guys asked before the show started. So I will start with those. So those of you that got here early, I will get to those questions. So I was covering the Berkshire meeting. I did an article for Forbes, just, things that I, found interesting from the meeting. And honestly, there wasn't a lot. It's not a criticism. It's just that, I've listened to so many of them. It's kind of the same thing. Maybe some might say that, Rob, you've just described your own show. But Bitcoin came up again. And, as you probably know, Warren Buffett and Charlie Munger are not fans of Bitcoin as an investment, or really at all. And it always receives a lot of criticism. And it did as well after and during the Berkshire meeting. And I wanted to comment on that because I think a lot of the criticisms that are leveled at Buffett and Munger misunderstand their argument or their perspective. And I think I'm gonna just go out on the limb and say I think I understand, and of course, for what it's worth, agree with their sentiment. But what I hear a lot is that they don't understand technology, they don't understand blockchain. They're sort of set in their ways. I mean, they are 91 and 98. One person I saw said they just can't really deal with societal change. That seemed odd to me. Two guys that have lived through, well, one of them, I guess, World War I, right? If I got my math right, more or less, or close. Not quite, I guess. The Great Depression, we could list it on. I think, they've probably, experienced their fair share of change, but whatever. I think what these criticisms miss, and first of all, in the legal world, we would say these are ad hominem attacks. You're not addressing the issue, you're attacking the person. But even putting that aside, the first thing they say is, look, Bitcoin is not a productive asset. All that means is that, unlike, say, a business that sells a service or a product and can make money, Bitcoin doesn't do that, right? It's a Bitcoin. That's all it does. Now, I suppose in theory you could lend it out. Of course, you can lend dollars out. You do that when you buy IBonds, for example. But I don't. That's not what they mean by productive, right? They mean something that can produce cash flow through, again, selling a product or a service, like a company or the S&P 500, right? And so I don't think that's controversial that Bitcoin is not a productive asset. If you own one Bitcoin today, 10 years from now, you'll own one Bitcoin. I guess you could buy more, but and that's where I think there's some misunderstanding, because one could say in response to that, well, Rob, wait a minute. You buy a share of Berkshire Hathaway, we'll just say the B share, and you hold it, he doesn't pay a dividend. So 10 years from now, you'll own one share. How's that any different than owning an ounce of gold, a barrel of oil, one Bitcoin? And the answer is, well, what that share represents. If we were to go back in time 10 years and say, well, what would one share of Berkshire own? You'd have your percentage of ownership, but what would that represent? Well, it would represent the balance sheet. You would have whatever that share of the company is claim on the assets of the company, the net worth of the company, the cash flow. You would own that cash flow. Now, you can't control it as a minority shareholder. So that's why it's important to understand management and are they trustworthy and integrity and all of that. But that grows over time. So what one share of Berkshire represents today is a lot different than what it represented 10 years ago. But 1 ounce of gold is still just 1 ounce of gold. It hasn't changed what it represents. And someone could say, well, but okay, but the price has changed. Yes, but if we look at non-productive assets, gold is maybe the best example. Over the long term, it basically keeps pace with inflation. It's not been a good investment. But back to Bitcoin, it's non-productive. And so, and it turns out with Bitcoin, it doesn't have much utility right now either. A barrel of oil has a lot of utility. A bushel of corn does. I guess gold maybe marginally, but not significantly, not like, say, silver, for example. So, and that gets us to this statement about he wouldn't buy all the Bitcoin in the world for $25. Imagine if you owned all the Bitcoin in the world. Would you be willing to sit on it for 25 years? You're not going to sell it. I wouldn't. Why? Well, because the only way this Bitcoin is going to be of any use to me is if someone wants to buy it from me, hopefully well, in this case, more than $25. But you think about it. If I wait 25 years, I mean, at that point, people have long forgotten about Bitcoin if I own it all and I haven't sold any. And that may seem like an academic kind of silly example. Of course, I guess buying all of the Bitcoin in the world for $25 could seem like a silly example, but it actually underscores a really important point. Compare that to all of the S&P 500 or all of Apple. Pick your productive asset. Would you hold it for 25 years without selling? I would. You'd own the cash flow. You'd get some dividend if you want. Perhaps most of the profit would be reinvested to continue to grow the business. And assuming the company did well, what you would own at the end of that 25 years would be significantly greater in value. Not because someone even wants to buy it, just the cash flow that it generates. And so that's, I think, fundamentally why Buffett and Munger are not fans of Bitcoin. Now, it's one thing to disagree with that. You could say, well, okay, you're right. It's not productive like a business, but I still think it's valuable. And here are my reasons. And I think it will continue to go up in value. And I think I will be able to sell it to someone else down the road for more than what I paid for, because that's the only way you're going to make any money from it. And that's fine. And that's many people hold that view. But I think it's silly to attack Buffett and Munger on the theory like they don't understand technology or they don't understand blockchain. I don't know what their understanding of blockchain is, but I do think what they would say is it doesn't matter. Blockchain could be the coolest technology in the world ever. That doesn't make Bitcoin, a non-productive asset that has, frankly, no utility, valuable. Now, maybe the blockchain in some application in the context of a company that sells services or products could be, that company could be extremely valuable, maybe at some point in the future. And who knows? It could be that, well, they already do own companies that are already exploring blockchain, like banks, right? So, but they would say, we don't need to understand blockchain to evaluate whether Bitcoin is a reasonable, sensible investment. And for what it's worth, I agree. Probably not worth much. That's my take. So in the chat, you can just fire me up and tell me why I'm wrong. It's okay. But I think it needed, I don't know. I felt like it needed to be said. I think it's sort of core to how Buffett and Munger think about investing. And I think how any value investor thinks about investing. And I think it's the right way to think about investing. All right, enough of that. That's my 2 cents today. So I can't put the first few comments up, but I can read them. So I got that going for me. From Kyle and Emily, with inflation at 8.5%, does this mean we should be increasing our emergency fund by 8.5% as well? No, I don't think so. I always think of emergency fund in terms of months of expenses. So, of course, if your expenses have gone up by whatever, and you want your emergency fund to cover, let's say, 6 months worth of expenses, then you'll need to increase it. But I would base it on months of expenses, and your expenses may or may not be going up 8.5%, right? So I wouldn't just arbitrarily increase my emergency fund by the rate of inflation. So that's my take. Good question, though. All right. Ethan, I have a chance to ask the CEO of the bank I work at a few questions. What should I ask? I don't know. Can I have a raise? I don't know. Are the questions about the bank? That's a tough one. I don't know. I guess it depends on what you want to get out of the conversation? Is this a one-on-one conversation? Is this in front of a group? Yeah, I'm going to need more than that. I don't know. I'm trying to think of something intelligent to say. Coming up empty. Coming up empty. I don't know. Maybe you'll add some color to that and I'll have an opinion. Another one from Kyle and Emily. Experiencing all the ups and downs in the market over the years and knowing what you do now, would 30-year-old Rob still invest in asset classes like REITs or stick to a 3-fund portfolio? I'd probably still invest in REITs. Well, understand a 3-fund portfolio has REIT exposure, about 2.5%, I think, roughly. But REITs, I like a little more real estate. I like it. I think it doesn't hurt returns. It adds a little diversity. I probably would still stick with REITs. I definitely still stick with small cap. Although at the end of the day, we have no idea if adding more of these to your portfolio will in the end, 30 years from now, increase your returns, right? We don't know. We can look at history, and I think that's of marginal value in my view. That's maybe a whole nother topic. I think what's probably more important is what do you need in your investment portfolio so that you can stick to it no matter what happens. That's the most important thing. And if you need some extra REITs or small cap value, or emerging market, or a QQQ exposure to kind of scratch that itch, so to speak, and stick to your plan, to me, that's probably the most important, criteria. Again, assuming we've got a well-diversified, low-cost portfolio. Josh says, what do you make of news articles about foreign investors selling billions in U.S. treasuries? I don't know. I haven't heard that story. I can tell you, well, billions is not much. I'm sorry to say. But like the 10-year treasury was actually down. Now it's back up a little, but it's still not, it's at 2.9. I'm looking at it now. It's at 2.977. It was above 3 at one point. Where you can see right in here, it got down here. But at least the 10-year, I don't know, whatever selling's going on, it's not like made some dramatic difference that I can tell. I didn't read those stories. I'll have to check them out. All right. All right, what else we got? Paul wants to know thoughts on segmenting out VTI, which is total U.S. stock market, into smaller funds for tax benefits. So you could think of, and he gives a bunch of tickers, but you can think of like large cap value, large cap growth, and so on. Then putting worst taxed into qualified. So let's just think about that conceptually. Imagine, we'll use the S&P 500 as an example. So that's large cap. So imagine rather than investing in the S&P 500, we invested half of whatever we were going to put in the S&P 500, half of it in large cap growth and half in large cap value. And then we could say, which one is the most efficient from a tax perspective? That's going to be value. I'm sorry, it's going to be growth. Why? Because growth is going to have a lower dividend yield, right? Think Tesla, Amazon, Google. There's obviously some growth companies that pay dividends. The yield won't be zero, but the yield's going to be lower for growth than it is value. And so you can then say, okay, I'll keep the growth. I've split the S&P 500 in two, or total market, and you can do mid cap and small cap, same idea. I'll keep growth in a taxable account and put value in tax deferred or Roth type of account. And I think it's a reasonable approach. It's a lot more work. And so you're going to have to think through how much money do you have in retirement versus taxable accounts? Can they both equally handle the allocations that you need for all of these different asset classes? For me, it's probably not worth the effort for me. Although I'll confess, I've never sat down and done the math and thought, okay, well, if I actually did this, how much might it save me long term? So Paul mentions that Kitces talked about it. And I don't know if he's got an article on that. You can drop in the chat. That'd be great if he does, because his work is terrific. So yeah, I mean, theoretically, and by the way, that's one of the selling points for direct indexing. So direct indexing says, rather than invest in the S&P 500 as sort of an ETF or mutual fund, we'll invest in the companies that make up the S&P 500. Maybe not all 500. You might get away with 100 or 200 and still track the market pretty closely. Now, of course, for you and I to do that by ourselves, that would be a mess. I mean, we just, as a practical matter, couldn't do it. But I think Vanguard's going to be offering it. Fidelity, Schwab's got it, I think, for 40 basis points. Fidelity, I think, for 40 basis points. I think Personal Capital does this. I think Wealthfront has some direct indexing. And the idea is there's sort of two benefits. One is you might get some more tax loss harvesting to the extent that a portion of these companies are in a taxable account. So the S&P 500 as a whole might be up, but that doesn't mean every company in the S&P 500 is up. And so maybe there are some companies that are actually down, and the Fidelity or the Schwab or the Wealthfront or whatever can sell some of those losses, put the money in a comparable company in the S&P 500 to avoid the wash sale, and then you get some tax losses. But the other part of it is you split it between value and growth, and you put the companies that have the higher dividend yields in the retirement account. Again, I'm not convinced it's worth the 40 basis points. I think Wealthfront's cheaper, but you've still got to have enough in the taxable account and the retirement accounts, both at the same companies. And by the way, I don't know how Fidelity and Schwab work. I just know that they have them because I was looking at them the other day. But I'm probably not going to deal with it, mess with it. I don't know. I'm still thinking about direct indexing. I'm going to do a video on it, but I want to study it more. I mean, I understand it as I just described to you, but I'm not convinced of its long-term value. I mean, I don't know. At some point, unless I guess if you're continually contributing, maybe you have tax losses along the way. I need to do more research on it, but that's the idea. And so, Paul, it kind of can, in a way, do something similar to what you're describing in terms of the tax benefits between growth and value, as well as, the tax loss harvesting. Okay. Am I caught up with the stream yet? I don't think so. I'm working on it. Josh wants to know, with interest rates rising in the next few months, well, I don't know, by the way, if they will or not. I guess the Fed's going to raise rates. We find out this week, right? Yeah. By the way, did you see that it's official? The IBonds 9.62, the fixed rate is still 0. That was announced today. In any event, with interest rates rising in the next few months, lower automatic DCA, dollar cost averaging, amounts now, then increase later, ? As a boglehead, is this bad because it's market timing? Well, I would say it's bad because it's market timing. Forget the bogleheads. I mean, I think that's what they would say too. By the way, I'm going to the Boglehead Conference in October. I hope maybe some of you will too. It's in Chicago. Yeah, I would just continue personally. I've never turned off, when I was contributing to a 401k or whatever, I've never turned it off because of interest rates, stock valuations, bond valuations. There's just, in my experience, you think you know what's going to happen. I'm telling you, it'd be fun to see at the end of the year, our last live Q&A for 2022, where the stock and bond market ended up, where interest rates ended up. Maybe it'll be what we might predict now, but I'm not convinced. All right. Punch King, do you have any opinions or advice on working with employer-provided financial advisors? And how does that advice compare to your recommendation to use hourly rate advisor? Well, I've never had that opportunity, so I don't really know. And it would depend on the fees. Is the employer paying for it? Are you paying assets under management? Are they hourly? You'd have to look at the details. I've never actually had that opportunity, not that I can remember. Okay. So TD55 wants to know, is a 90% S&P 500 and 10% bonds still a good play? Should I be 95% in stocks, 5% in bonds? This is for my 403B. Well, there's all kinds of questions that need to be considered. How long until you need the money? What other assets do you have? How much debt do you have? What's your risk tolerance? Can you, a 90 or 95% stock allocation, at some point, assuming you're not Warren Buffett's age, at some point, you're probably going to lose 50%. Are you okay with that? Can you survive that? I mean, that's just the reality. Now, the truth is, if you drop to 80-20 in a market that would lose a 90-10 portfolio 50%, it would lose an 80-20 portfolio a lot too. It wouldn't be 50, presumably. I guess it could be. It could be worse if bonds are down. I don't know. So, one can justify a 100% stock portfolio. Again, I'm not a big fan of that, but I get the argument. I wouldn't tell someone in their 20s or 30s or 40s that kind of portfolio is just wrong and you're making some big mistake. But you can't really answer these questions in a vacuum. So I think for the right individual, I still think a 90-10 portfolio is perfectly sensible. All right. Let's see. Am I caught up yet? I don't know. Anyway, I think I'm close. Tony, thoughts on Phil Town's book, Rule Number 1 and Strategies he applies? Feels like a bit of market timing. Yeah, I'm not a big fan of it. I'll be honest, though, it's been a while since I've read it. And so I don't actually remember the details. I just remember it was like, this sounds a little fishy to me. But I don't remember any of the details. So, Marty, greetings from Long Island. Son-in-law from Akron. Nice. You got to be tough to be from Akron. Thomas wants to know, how much is too much money in my retirement account? How do I know if I have enough money for retirement? Oh, those are two big questions. I'm not sure I can answer those quickly. I mean, first of all, let's start with how much money do you need for retirement? I think from a planning perspective, I like the 4% rule, which means the way I think about the 4% rule, I kind of invert it. So take your expenses in retirement, your first year. What are your expenses going to be? Subtract any other sources of income, Social Security, pension, whatever, and whatever you're left with. And we can include taxes here. Again, you're going to include taxes in the expenses you need to pay if most of your retirement accounts are traditional. If they're all Roth and you don't pay any taxes, then you can ignore taxes. But whatever's left, whatever expenses are left that you're going to need to cover from your retirement account, multiply it by 25. And that's roughly how much you need. Now, that is a gross generalization. There are all kinds of factors. Like, for example, if you tell me you're retiring and you're 37, I'm going to tell you to multiply that by at least 33 and maybe more, because you've got a long time. But if you're going to retire to a traditional, 65, I think generally the 4% rule is a good rule of thumb. Now, you can get very precise with this analysis with a tool like New Retirement, for example. I did a whole live show on New Retirement, but as just a general rule of thumb, take what expenses you'll have that need to be covered by your retirement account, assuming a traditional retirement age, and multiply it by 25, or if that makes you uncomfortable, 33. Now, how much is too much money in your retirement account? Well, I guess it depends on your perspective. It's kind of, for the vast majority of people, it's kind of like, that question kind of reminds me, at least for most people, when you're golfing and you got a buddy and, maybe he's in the fairway and he wants to know the distance to the pin, and you look down and you're thinking to yourself, the distance to the pin, about 400 yards. I think you should just swing, buddy. You don't need the distance. Oh no, I got the distance. It's got the old viewfinder out. Okay, 412 yards. All right. Just keep saving, right? I suppose from a tax perspective, some folks could get to a point where it may not make sense to keep adding to, say, a traditional retirement account, maybe. But that would be an impossible question to even, I think, evaluate in a vacuum. And maybe for most people, you'd never get to that point. Why not keep saving? I guess unless, I suppose, if you had enough in a retirement account to retire at some point in the future when you wanted to retire, and you didn't want to keep contributing now because you wanted to spend the money, all right, there you go. That may make sense. They call that coast fire, right? Where you've got enough saved such that, assuming reasonable returns, you don't have to save any more for retirement, and you can coast to whenever it is you're going to retire. I don't know if that's helpful. That's my answer. Fabiano, hello and good evening. Betsy in New Hampshire, welcome. Someone said good afternoon, Bispa. I don't know where you're from. I guess maybe California. You predicted S&P 4,000. You still think 4,000? I'm betting we go lower. Did I predict that? Was I just being goofy? I don't even know what the S&P is right now. I have no clue. It's 41.55. Oh, I don't know. I'm sure I was just saying, I don't know. I have a clue, 4,000. But if that's what I said, I'm sticking to it. Philip, I'm getting down to the questions here now that I think I'm going to get maybe to the, oh, I am, yes. I can now show you the questions. I overlapped and realized it. This is confusing. Here we go. Did you register for Vocalheads? I did. Oh, Philip, anyone going to the conference, we can get together. I don't know, have a meetup. Why not? That'd be fun. All right, Karen has a question. What is the best approach to deal with short-term losses of more than 10% year to date? Do you recommend tax loss harvesting? Buy more shares or do nothing? Well, if you can harvest some tax losses in an amount that's meaningful to you, it's going to vary from person to person. I think it's a good idea. And depending on what you're invested in, you can then immediately reinvest the money in a different, say, fund, but that tracks the same asset class in a similar way. It doesn't have to be exact. Well, obviously, you got to avoid the wash sale rule. I'm not one to do tax loss harvesting and then wait 31 days. And remember that 30-day period is both before and after you sell at a loss. So you can't buy and then 15 days later sell at a loss the same investment. You're going to trigger, it's 30 days on either side of the sale that generates the loss. But I mean, if you can generate a tax loss that's meaningful to you in your tax situation, I don't know why you wouldn't. In terms of buying more shares, my approach has always been, if I'm investing monthly or whatever, I'm just going to keep buying, always, irrespective of whether I'm going to sell something at a tax loss. Again, if I sell something at a tax loss, that will affect what I buy during that window, of course. But yeah, I'm, at least for like low cost index fund investing, I'm, if it's a 401k or whatever, I'm putting the money in every month. There's just too many, it might be worth taking some notes about your thoughts on the market. Record your notes about your thoughts on the market today, and then look at it 6 months from now. You'll be surprised. I mean, they're just, we think we've got it all figured out, and we just don't. Here's an interesting question. Ethan again. Isn't Ethan the one that's got the meeting with the banker? Or is that a different Ethan? Now he's a CPA? What in the world? It's the same Ethan. I don't know. I just started a CPA firm doing tax and bookkeeping. Any tips on starting and growing a business? Also thinking of adding CPA to include fee-only planning advice. Thoughts on that? Well, if you mean like investment planning, of course, you'll need to take the Series 65 and become a registered investment advisor, right? If I understand your question. One question I have for you is your business just local? One thing that I have found, it takes time, but if you can have an online presence, YouTube channel is great. Like if I wanted to manage investments, I have no doubt that I could be managing tens of millions, if not hundreds of millions of dollars quickly because of YouTube and my work at Forbes and other things. I don't have any interest in doing that, as it turns out. So there's that. But I know a lot of investment advisors who are active on Twitter, active in some way, and have really leveraged it well for their practice, and provide a lot of value to people, whether it's on Twitter, on YouTube, who don't hire them as well. And so I think that can be a great approach. The thing is, and this is why most people don't do it, actually, is the results won't be immediate. I mean, when I started YouTube, I wonder if I can show you. When I started YouTube channel, I've had the YouTube channel forever, but I didn't start really about a year and a half ago. Let me just see how much data can I show you? Will it let me? So yeah, let's look at this. So this is my YouTube channel. So last month, the channel had, as you can see, 400,000 views. January is always a big month. I had 700,000, 689. But look back here in April of 2021. I don't know what that number is. It's small. Well, there we go. 26,000 views, right? I mean, not a lot. And if I went back further, it would obviously be smaller. And so, when you're starting, you're talking to nobody, right? And that can be disheartening for folks. Same thing with starting a blog. You start a blog, you're writing the best content you can, you publish it, no one sees it. And it's like a flywheel, really hard to get moving. But if you've ever been like in a spin class and you try to stop, you're flying and you try to stop it with your legs rather than that red button you smash, it ain't easy because once it gets going, so that's the trick. But I think that kind of thing, it can be great for a CPA, bookkeeper, investment advisor. Oh, hey, Mom. Whoops. Did I wait. There we go. Oh, that's not my mom. Well, my mom says, I love you, Mom. Oh, that is so sweet. And it is my mom. I own $500 in crypto. That's not my mom. That's David. All right. I'm not here to tell anyone that they shouldn't own crypto or that if they buy Bitcoin, they'll lose money. You might not. Obviously, some people have made a fortune in Bitcoin. But I don't own any. I do own a little crypto, but it was more of like a fun thing to do, and I won't buy anymore. And I didn't really, it's just, anyway. What is this? This is Tony. Rob, I've created a portfolio that consists of 60% crypto between Ethereum and Bitcoin. The other 40% of the whole is traditional stocks and ETFs. Do you have any thoughts on this? I am under 30. Well, I wouldn't do what you've done, Tony. I think for all the reasons I talked about at the top of the show, crypto is a non-productive asset. It doesn't even have much utility. Bitcoin has virtually none. So I think betting 60% of your portfolio on a non-productive asset is not, in my view, a reasonable approach. If you think of investing as putting your money to work in a way that we have some reasonable belief that you'll grow the purchasing power of your money, I don't think this portfolio, in my view, qualifies for that. I'm sorry to say. Shorty, recent subscriber to newsletter, and I have to say, really enjoy your articles. You know, there's a link below this video if you want to join the newsletter. It goes out every Sunday. Had actually a little bit of a snafu. Ended up going out Sunday like evening. Anyway, I really have fun putting that together. I read, skim, look at probably 100 articles, and end up putting in, I'd say most weeks there's maybe half a dozen. It's a lot of fun. Okay. Okay, let's see. Well, Quincy, I have 50,000 in stablecoins. Why? I don't understand. What's the purpose of that? I wouldn't know. I mean, they're unregulated. I think all of them are. I don't think there's any at least in the US that I know of. I just don't know what the purpose of that would be. So I wouldn't be comfortable with it, no. All right. Stephen, it's good to see you here. Stephen and I have emailed back and forth for a long, long time. I don't know how long. All right. Let's see here. Sergio says, I'm 23 and typically dollar cost average into a Roth IRA, currently in one of the worst year-to-dates in a while. I doubled down with $1,000 into S&P. Am I missing the forest for the trees? Well, you say you doubled down, which tells me you think you're making a wager almost. Again, have an investment plan. If that's putting $1,000 every month, every quarter, every year, $100, whatever it is, and just keep doing it. I'm trying to think of something smarter to say than that. I can't think of anything. Now, I will say this, though. I will caution you. You need to set the right expectations. If your expectations are, well, the S&P 500 is down, whatever it's down this year, 10, 15%. So it's a good time to buy. Keep in mind that the S&P 500 can easily drop another 10, 20, 30, 40%. Or could drop more. And by historic standards, it's still expensive on a PE, or, I guess you could look at other valuation metrics. By the way, I don't mean to say you shouldn't keep with your investment plan. I think you should. But from an expectation perspective, it could easily go down more. The thing is you're 23. So this was the point of the video I published earlier today. As a 23-year-old, you want the stock market to crash so that you can keep making your investments, and you're going to be investing in at lower and lower amounts. When the companies pay a dividend and you reinvest that, it gets reinvested at lower amounts, lower costs. When the companies buy back their shares, they're buying them back cheaper. The best thing that could happen for you, maybe not for old people like me, but for you at 23, would be for the market to crash and to stay crashed for a long time. As long as the system itself didn't break. We don't want Thunderdome, but, short of that, yeah, you want it to be 50% lower, at least for now, until you're ready to retire. All right. So here's a good question from Mike. What is your opinion on Fidelity and others offering Bitcoin in their 401k offering? So this question, a lot of thoughts go through my mind. Here's the thing. When it comes to finances and money, and this is true for brokers, it's true for personal finance blogs or professionally run sites. Most of them are trying to figure out what the consumer wants and then provide that to the consumer, right? That's what Home Depot does. They want to know which hammers people want to buy. Now, it's not always the best hammer. There's a price issue, quality issue, but they want to give the consumer whatever the products that they want. If no one wants to buy a hammer, Home Depot will stop selling hammers. Okay, and so Fidelity is no different. So Fidelity believes that people want to invest in Bitcoin inside their 401k. And so they want to try to offer it if the SEC will allow them. You might say, well, wait a minute. Isn't there someone at Fidelity who says, okay, wait a minute. The consumer might want this, but don't we have an obligation to first decide if we think it's a good idea? Because just because the consumer wants, maybe this consumer wants heroin. Should we offer that? Probably not. Of course, it's illegal, so there's that, but different issue. But these companies, I think generally, I don't say this to suggest some evilness to them, but they're trying to give the consumer what they want. I've noticed this with the big personal finance sites. They're going to promote Robinhood because that's what, at least not anymore apparently, but at some point that's what people wanted. It doesn't matter if it's good for you or not. If it produces good investing habits, it may produce bad investing habits, but it's what the consumer wants. So the big finance sites that make money through affiliate marketing, by the way, I do too, generally aren't going to make that kind of judgment call. I think the smaller sites, and I know many bloggers, I know this is about Fidelity, but it's the same concept, do make those judgment calls. So I don't promote Robinhood. Would I ever be an affiliate and make money from Robinhood? I suppose I might. If I did, though, my review of Robinhood that had the affiliate link in it would be honest and would be very negative. And it would say, you really shouldn't open a Robinhood account. And if people wanted to open it anyway, I suppose, why shouldn't I make a few bucks? But I haven't done that. My point is, the smaller sites are going to try to make a judgment call. Now, my judgment call may be different than another blogger's judgment call about what I like and don't like and what I promote and don't promote, but at least I'm trying. I'm trying to decide. I'll give you an example. I get emails from potential advertisers. I got one. What is it? They you can invest in art. I forget the name of it. They email me all the time. Like 2-3 times a week. But I just don't view artwork. I just don't view that as a sound investment. I don't know. But Interactive Brokers reached out to me. All right, now wait a minute. Okay, now that's a solid broker. I've never used them before, but I've heard very good things about them. And I had a phone call with them. So I'm making a judgment call. One of the things I liked about the phone call was they said, look, you can't promote us if you do it all, if you want to, but until you've used our platform. You don't have to put money in, but you've got to log in, sign up, log in, evaluate the platform, and then we'll have a discussion. I thought to myself, that's fantastic. That's what I'd like to hear all advertisers say. Most of them don't say that. They don't care. Just promote us. So anyway, this is a crazy answer to what was a pretty basic question. My point is, I think a lot of the smaller bloggers and whatnot are trying to make judgment calls about what they think are good for their audience and not good for their audience. The larger sites, and maybe the larger sites can't do that. When you've got millions and millions, I had millions of visitors, but when you've got like tens of millions of visitors, there's so many different perspectives. How can you really, I don't know, maybe you can't do that. But you bring this back to Fidelity. And I think for Fidelity, the equation is simple. Bitcoin is just generally accepted. Who cares what, Warren Buffett and Munger think? A lot of people think Bitcoin's a great investment. It's certainly mainstream now, and people want it in their 401k. So let's put it in. I think it's a terrible idea to invest in it inside a 401k or otherwise. I don't really know where all that came from. Is anyone even still watching? I don't know. Yeah. Kenneth, can you explain? Ken, how are you, man? I know Ken. I don't know where he is now. I knew him back in the day from, pretty sure it was Red Ventures. What? Did I? Oh, I looked up the wrong person. You guys are like, Rob, why don't you just answer the question? Why are you all searching? Nice. Anyway, well, yeah, I mean, there are a lot of, it depends on the other crypto. And you know, I have some understanding of this. I don't consider myself a crypto expert, but there can be differences between some crypto have a cap in terms of how much can be mined. Bitcoin is an example. Others do not. Some do, some don't. You know, you think about Ethereum, which is the other, I guess, is it the second most in terms of market cap? I assume it is. We can look up the market caps of these. Let's see. Yeah, Ethereum is number 2. So we'll look at it here. Let me take the comment down so you can see. So Bitcoin market cap is down, of course, because Bitcoin's down. It was much higher than this, but it's 735 billion. And then Ethereum, these are, we'll just for now say these are the same. Don't email me and tell me that I know they're not the same. But anyway, 350 billion. And then Tether is, you know, just dollar for dollar. It's always worth a buck. Who knows what it's backed by? That's a whole other story. So obviously very different market caps, but some of them have this idea of smart contracts. Ethereum, it would be one of them. Solana, I believe, is, and if I'm wrong, someone in the chat can correct me, but I'm pretty sure that's a smart contract. So is Cardano. And the idea, you know, you could imagine, you could think of it as you could have a contract with someone else that in some way, when something triggered it one way or another, it could automatically send, let's say, Ethereum, Ether to one party or another. You could execute this contract automatically. And there's been a lot said in favor of smart contracts. People think they're going to be the next thing. I'm not at all convinced. I'm not saying that they don't have a future, but like, you know, I hear these ideas that, well, you know, all your property records and your marriage licenses, they'll all be on the blockchain. And I'm thinking, really? I'm not sure why. I mean, I get the idea that it takes the middleman out, meaning the courthouse in the county where you live, for example. But in the end, I can't help but wonder if it's just going to replace it with a different middleman. And I'm not at all convinced. But in any event, there are smart contracts associated with some of these cryptos. You have some that are specific to like the metaverse. Oh, look, did I show you this? Maybe I didn't hit the button. Anyway, if I didn't, sorry. If I did and I forgot, then I'm losing my mind. But here's the market cap. This is just on Coinbase. You can look this up yourself. I own a very small amount of Ethereum, a very small amount of Solana and Cardano, and Mana. Mana is associated with the metaverse. Where is it in here? Trying to look it up, see what its price is. Decentraland price $1.52. Yeah. So I don't know, Ken, if that's helpful to you. That answer. It's a very I guess shallow answer. I mean, it's a rough understanding at a very high level of just a few of the cryptos, and yeah. They have, you know, there's also, I should say, the way in which you have something called proof of work and proof of stake. And these, and I'll pull up, oh, my good friends at Forbes Advisor, where I was, this is where I worked. And I worked with Ben. There's a whole article on proof of stake. So that's the sort of the mining that goes on behind the scenes. And there's proof of work and proof of stake. And there are two different approaches. Stake would involve, you'd have to own the crypto, right? But there's articles on that. If you're going to study it in more depth, you definitely want to look at proof of work versus proof of stake. Yeah. All right. By the way, going back to Buffett and Munger, I think what Warren Buffett would say, and I kind of alluded to this, but I think he would say, look, I don't need to know a thing about crypto or the blockchain to know it's not a good investment. And that sounds wrong, I think, but I think he's absolutely right, because no matter what you tell him about the blockchain, Bitcoin is still a non-productive asset that's not even doesn't even have utility, and that's all he would need to know. He's done. He's out. Anyway. All right. Brian, love your channel. Thank you. Is investing in VTI, VXUS, BND at an 80-10-10 a good mix long term? I think so. I think it's great. Well, I think it's good. I personally would have more in VXUS. I might be 70-20 or 65-25. But I won't quibble over this. Obviously, the VTI, even though they're all US headquartered companies, do business around the world. But yeah, I think that's one of many reasonable approaches to long-term investing. Yeah, I sure do. All right, Anne, here's an interesting question. How do you plan in your 80s with the possibility of assisted living or nursing home expenses, yet the desire to leave individual stocks, possibly large gains, for inheritance? Well, and that's a good question. I guess I can only think about this from my own perspective. And it would be that I've got to take care of myself and my wife, and we've got to take care of each other first before we think about what we might leave to children, others, charities, right? It's kind of like put the oxygen mask on first before you help someone else. And so I would definitely make sure that, we were provided for, whether it's assisted living, nursing home, whatever, first. That, to me, that has to come first. Now, the interesting thing about leaving individual stocks, I was looking at the IRS just issued some proposed rules related to the Secure Act, which was what increased the RMDs from 70.5 to 72, but it in most cases got rid of what's called a stretch IRA. But the rules are hundreds of pages long, very convoluted. They've come under a lot of criticism. And I'm going to do a video on it. Actually, my video today was going to be on it. And I concluded after an hour of research that they're so convoluted and complex that I need to do more research. And so, but the reason I bring it up is that it's going to likely make leaving traditional IRAs to a non-spouse as not the best way to go. You'd be better off leaving a Roth or taxable accounts like individual stocks with large gains because of the stepped up basis, right? Now, what that could mean, I think, is that the order that you tap your retirement funds from is a lot of things to think about. But if you, like Anne here, who's thinking about inheritance, what you leave, what type of account you leave, and therefore what accounts you spend from, the inheritance and these rules on non-spousal inherited IRAs, and there are other exceptions to the rule that you can no longer stretch out the IRA. The way it used to work, a non-spouse inherits an IRA, you could choose to say, okay, I'll just take RMDs over my lifetime, which is what I did when I inherited a small IRA from my stepmother. That's no longer going to be available except if you're a spouse, and there's some others, like if you're disabled, if you're a minor child, there's other rules. But you're no longer going to, unless you qualify for that exception, you're no longer going to be able to stretch out the RMDs over your lifetime. Instead, you're basically going to have to take all the money out within 10 years. So if you leave, a lot of money in a traditional IRA, good for the person inheriting it, the non-spouse, but they could end up with a big tax bill. So as part of tax planning, and I'm not a tax professional any more than I'm a crypto expert, one approach might be to actually spend from your traditional accounts. If you've got a lot of money and you've got a lot to leave people and you've got taxable and maybe Roth, those may be better vehicles. So, and I don't know if that helps you in any way. Obviously, you're going to want to talk to a tax professional on that. And I can tell you, even the professionals right now are having a hard time understanding the new rules the IRS has just issued, and it's not at all clear that they'll be final. So I don't know. I don't know if that was helpful. I hope it was. This is a great question. Chris, so famous paintings have no value. Absolutely, famous paintings have value, which is to say, at least right now, people are willing to pay money for them, right? So, but they're not a productive asset, right? And I'm not sure that the reason a Monet has value will apply to Bitcoin, right? And actually, I think during the meeting, Buffett actually referenced the value of a famous painting, I think. So yeah, a famous painting can absolutely have value. Doesn't necessarily make the painting a good investment. Again, that'll come down to what you paid for it and who's willing to buy it for more at some point in the future. See, if you own a business that's making money, it can be of great value to you, whether you could never sell it. I'm going to keep it forever. Like ants, keep your individual stocks. They're going to pay a dividend. They're going to reinvest some of the profits and grow the business over time to pay even more dividends. I hope that makes sense. Yeah. But great question, Chris. I mean, and it's a point to consider. All right, Fabiano. I missed the April deadline to buy IBonds due to a clerical error. Is it still worth buying IBonds at its current rate? I think so. You're going to get 9.62% for the first 6 months. And then the second 6 months, you'll get whatever the rate is that's set in November, which we'll know what that rate's going to be, I think, by the August CPI reading. But you can follow it. So April was big. So you can kind of add up the CPI numbers month to month and know what it is. But I would, if I hadn't bought already this year, I would absolutely buy now. Mm-hmm. Now, one approach you could do. So the one thing to keep in mind with IBonds, whatever the rate is when you buy them, you're going to get that rate for 6 months. So the new rate started in May this month. But you don't have to buy it in May to get that rate you could buy it in June. And you'll still get the 9.62% for 6 months. Your rate won't change come November when they announce the new rate. When the rate on a bond changes depends on the month it was purchased. So you could, in theory, wait until October and buy the bond then, at which point you'll know at least the variable portion, the inflation adjusted portion of the rate in November. You won't know the fixed rate until they announce it the first business day of November. So you could do that because you'll get the full 6 months, and then when that's up, you'll get whatever the rate is in November. Your rates will adjust in months other than May and November. Hope that makes sense. That's about as confusing as my description of proof of work and proof of stake. Okay. Let's see. Clarice, would you hold Berkshire, the B shares, in your taxable account? Absolutely. I ask this because although they don't give out dividends now, maybe they will after Buffett and Munger retire. Oh, I like it. Yeah. It's hard to imagine that. So by the way, I've had that same thought. I've wondered that after Buffett and Munger retire, will they start paying out dividends at some point? And I suspect they will, but I still suspect it'll be a pretty tax efficient investment. It's hard to imagine that they start paying out yields of like 4 or 5%. It's still going to probably be relatively small, I would think, but that's just a guess. All right. Kenny says, were stocks and bonds down in 2008? Let's see here. This is from New York University, 2008. Yeah, they were. So the stocks, S&P 500 was down, as we know, 36%. And, oh, wait, maybe they weren't. No, they weren't. U.S. Treasury bonds were up that year, 20%, big time. See, that's what we want, right? That's normal. I guess I can take the comment off the screen so you can see. That's the kind of diversity we want. Corporate bonds. So this is interesting. Look at corporate bonds. This is corporate, right? Let me just double check. Yeah. Why would corporate bonds be down 5%, but treasuries up 20? Well, remember, we were going through terrible recession, financial system cratering, housing cratering. And so obviously it's going to hit stocks big time, but these same companies, right, are the ones that have to pay out on the bonds. Now, bonds have precedence over the equity, the shareholders. So the bonds get paid first. So they're not going to typically get hit as much, but they're still going to get hit, which is one of the reasons, maybe the primary reason, that treasuries generally are a better diversifier to stocks than are corporate bonds. All right. So this is an interesting question from Quincy. Have you reviewed Acre Trader? So I actually had lunch with the folks at Acre Trader when I was at a conference. I really like the idea of investing in farmland. I haven't pulled the trigger. It's not very liquid, at all, really. Your money's in there for a decade or whatever. Although that could also, that's going to factor in on valuation. So that could actually be a positive if you really don't need the money. And I do think farmland is generally historically been a pretty good diversifier from stocks. Everything I've heard about Acre Trader is positive. I had a positive vibe from the people that I had lunch with, but I haven't actually invested, so I can't speak from experience. Okay, we're back to Ethan. He's going to be asking the CEO questions in front of a group. Thoughts on investor questions to ask management of a publicly traded company? Well, what questions? Of course, it would depend on the bank. And I would probably read their latest 10K or 10Q. And I'd listen to the latest earnings call for ideas. I think, depending on the bank, you might want to have an understanding of how a rise in interest rates will affect the bank. The general idea is that it will help banks as interest rates go up because their net interest income, there's a spread between what they pay for their capital, whether it's to a depositor, bondholders, or whatever, and the loans that they're lending out, right? But exactly how rising rates will affect a bank will depend on the type of loans that they have. And, are they commercial? Are they residential? What are the terms and the sort of the duration of their loan portfolio? So That would be one question. How will rising rates affect the bank? I'd be interested in knowing if they have exposure to what's going on in Russia. Again, it depends on the bank. If it's some community bank, then they're probably not going to have exposure, I wouldn't think, to what's going on in Russia and Ukraine. I might want to know something about technology, how they're, what's on the horizon for, particularly from the consumer side. Do they have any interesting projects going on with tech? Because that's one of the things that can distinguish, banking at the end of the day for you and me, checking account, savings account, it's just a commodity. What are the fees? What are the rates, right? But banks can distinguish themselves in part from their technology. Something as simple as an app. I mean, that's why fintech has done so well, like Chime, for example, a good app, right? And some banks have good apps and some maybe not as good. But beyond that, I mean, to come up with questions without knowing the bank and reading something about them, that's kind of what I can think of. Doesn't sound all that impressive, though, as I run back through my mind what I just said, if I'm being honest. All right. Rob, this is from Ronan. Tell us about your two keyboards. Well, this one is my clickety clack. It's an F96. Quinix, I think. This is the clickety clack. I love this keyboard. Let me show it to you if I can type. Here it is. Oh, there's my board right there. $199. I don't remember what I paid. It's sold out. Hello. Maybe I should auction off mine. They have other colors, so I don't know. I'm sure they've got the Joker. Oh, add to cart. There you go. There you are. This thing lights up. I don't ever turn the lights on, but it can light up and do all kinds of goofy things. This other one, I don't even know what this other one is. I bought a gaming PC. This is a Corsair. I have a screaming fast gaming PC. That's actually what's running this live show. And it's got is it a 3080, I think? It's got a pretty solid video card and tons of RAM and a Threadripper 32 core, I think. Anyway, I don't remember what keyboard that is, and I don't want to pick it up and have the whole thing fall apart. Gaming keyboard. This might be, if this isn't it. If this is very similar, right here. Oh, there you go. Yeah, I think that's it. Or it's awfully close. It's not exactly the same, no, but it's awfully close. It's a Corsair. Yeah, there you go. Ethan, is this Ethan? You're like the busiest guy in the world. I mean, you must not sleep. I don't know. Thoughts on starting an online business, Amazon, blog, something else. So I'm not really an Amazon fan but some people make a lot of money. I'll show you an example. A friend of mine, I say a friend, I guess an acquaintance. I haven't seen him actually in a few years. But he goes to a conference that I go to every year. Let me take the comment off the screen. He owns this website, Swim University, and he was a pool guy at some point. And so this is a blog about how to take care of your pool. But he's got like, here's an example. So if someone's looking for a robotic pool cleaner, we have one of those. We have a pool. We don't have this fancy one. But in any event, you'd he reviews these, and his name's Matt. And see here, and he knows what he's talking about when it comes to pools. And if you were to click on this, let's see where it takes us. Here we go. And you bought that, he'd make get a fee. And this is his full-time business. I think he has some other websites, but that's a perfect example. He's been doing this for years. And there you go. Download our free pool care cheat sheet. He wants your email address, and he'll give you a pretty cool cheat sheet if you give him your email. So there you go. That's an example. I guess that's a blog, but a lot of it, I think his revenue comes from Amazon. And he actually blogs about all of this from a separate blog. Let me see if I can show you that. I think it's this, right? Yeah. Oh, yeah. So he has a site called moneylab.co. There he is. There's Matt Giovanisi. I can never pronounce his name. Really funny guy, funny videos. And here he talks about basically building an online business. So you could check that out. Actually, another one, if like you want like the I'll call it the technical side, but LarryLudwig.com. Larry's a good friend of mine. Known him for years. He sold a blog like I did. In fact, he sold his to the same company. He used to own Investor Junkie. And now he writes about building an online business. A lot of great content there. So yeah, so I would, the way I've done it is I still have a couple of websites. RobBurger.com is one of them. I have the YouTube channel. I actually have Amazon links, like to my own book, and if I mention a book on here and I put a link below the video, it's an affiliate link. I've never made much from Amazon. It's usually maybe not much at all, $50 a month kind of thing. But, someone like Matt or, folks that love photography and they link to Amazon to buy expensive camera equipment. They can make six figures, a year easily. Not easily, it's in overnight, it takes a lot of work, but I mean, you could easily generate that. There I go again, easily. Those kind of blogs, if you get a lot of traffic, can generate that kind of money from Amazon and other similar, Amazon's not the only shopping site with an affiliate program, of course. Most of them have them. So there are other places to buy, say, camera equipment. Wouldn't have to be all to Amazon. Anyway, those sites will keep you busy for a while. All right. Bill says, we plan on keeping 20% of our portfolio in bonds. Your thoughts on BIV versus BND? Let me look up BIV. So this is BIV, and I confess I don't know the difference between BIV So BIV, which is just, when I say BIV, I'm just referring to the ticker. If we come down here, we can see that it's got 60% in government bonds and the rest of it, for the most part, in corporate. What's the difference between BIV and BND? BND also has exposure here, securitized, which is basically mortgage-backed securities. And so there's two schools of thought. The one would be that BND might be better because it's a little more diversified. You've got mortgage-backed securities. Let me take the comment down. Here we go. But the other argument might be you don't really need mortgage-backed securities. If you've got REITs or whatever, you've got some real estate. Of course, that's on the equity side, not the fixed income. But you really don't need REITs. And I don't have a strong opinion. I think either of these would be perfectly fine. I will recommend, though, something. It's a podcast episode that I listened to this weekend. And it's from my good friend Rick Ferry. So he'll be at the Bogleheads conference. Here it is. So I just Googled Boglehead's podcast. It's this episode right here. I forget which is which, but I think Nick is from Bloomberg. One of them's from Bloomberg and one's from Vanguard. Anyway, I think Nick is from Bloomberg. Yeah. So, and he interviewed both of these guys in this pod. It was a fascinating interview, and I learned a lot about bonds. I mean, for example, I don't know about BIV. We can look here. Let's look at BND. So here's BND. I want to look at the portfolio. Yeah, see, this is interesting. This is where you might not get accurate information from Morningstar. Let me go over to, I'm going to look at BIV at Vanguard's website. There's a point to this, trust me. So now I'm looking at BIV at Vanguard. What I'm looking for, foreign 4.5%. What I learned, now this is BIV, right? Let me pull up BND. You think of these funds, at least I always have, as total U.S. market funds, right? But now let's see what this is. It's gonna be higher, I think. No, about the same. What I learned in that, among other things, in that interview, was that BND holds Yankee bonds, right? Bonds issued by entities outside the United States, but that are dollar denominated. So think Mexico. Mexico issues a bond in dollars, so they're gonna borrow dollars and pay back in dollars. So the Bloomberg U.S. aggregate index, bond index, includes Yankee bonds. So a little diversity there that I kind of like. That I didn't realize that was the case. I think it's about 2 trillion on 25 trillion. Is that what it was? Yeah, it's about 8%. So I don't know exactly. Like this one's from Vanguard foreign is 3.7. I don't know how that's calculated. And maybe it's just a little different than the index. I don't know. So fascinating interview, about how the index is constructed. I didn't know a lot of the bonds aren't priced. They have to use a service to price the bonds. They're not traded in the open market. So when you see the values changing, a lot of those are just from a service that prices them. The index uses them at Bloomberg. Vanguard uses pricing services. I didn't realize that. It's a total U.S. bond fund, but there's a lot of bonds it doesn't include. It doesn't include TIPS, which they would view as investing in inflation, effectively. It doesn't include high yield. It doesn't include, obviously, emerging markets. So it's kind of a total, I'll put in air quotes, U.S. bond fund. But, between the two, I tend to lean towards BND because of a little extra diversity. But it's hard for me to have a strong opinion one way or another. Okay. From Ryan. My Roth is in VU and FSKAX, which I think is a total U.S. stock market, right? Let's just double check. Yeah. Would it be wise to just invest in FSKAX since the holdings overlap? Yeah, I mean, VU is an S&P 500 ETF from Vanguard, right? Just pulling it up, but I don't see a reason to own them both. I mean, I suppose if you wanted to have the whole market, but then sort of overweight large cap, if that's your goal, then maybe. owning them both would make sense. But short of that, you just have simpler, portfolio to manage if you just have the total market. All right. Let's see. Here's an interesting question from Scott. Assisting my mother with her portfolio, and she needs to take her first RMD this year. If we're thinking of adding the RMD to a taxable account with a similar asset allocation, does timing really matter? Off the top of my head, I can't think of, well, one thing maybe is you're going to have to pay tax, right? Or it's going to be taxable income. And that might mean paying quarterly income tax, right? Potentially. I mean, I'm not a tax expert, so you don't want to talk to a tax pro. And so when you take the RMD, I don't know, some might want to wait till later in the year before they have, so that they can sort of delay the estimated income tax, in order to avoid a penalty. So that's one thing to at least think about. But in terms of just asset allocation, I don't think it matters. You're just going to move it from one account to the other, minus the taxes. I can't think of why timing would matter beyond taxes. So here, could you make a video on mid-cap funds? Haven't found it on YouTube. Why are they ignored by most investors? Well, if you have a total stock market, you're not ignoring it, right? I mean, we can look at Fidelity's total market fund portfolio, and you're going to have what, 10, 15%, 10%? Oh, 19% mid-cap, right? See, I'm adding the numbers here in the middle row. That's mid-cap. So you're not ignoring it. But I suppose you're not overweighting it, which you could with a second fund that focused on mid-cap. But yeah, I can do it. And it'd be interesting to look at mid-cap and how it's performed. Well, there's a lot of talk on small cap, right? Because historically it's outperforms, particularly small cap value. Let me get rid of the comment there. Sure, why not? Happy to. I have to think of something to say. One thing I remember reading was that actively managed funds in the mid-cap space had a better shot at outperforming the index certainly than large cap. That does, by the way, it doesn't mean I would invest in an actively managed mid-cap fund, but I remember reading that somewhere at some point. All right. I'm doing a live stream. It's my son saying hello. All right. Someone needs help. Please help me get started. I'm 45, have a lump sum to start, steady stream of income. What would my first steps be? Self-employed, so I'd love to get some tax breaks. Can invest 50%. Well, so for the first question, here's what I would do if I were in your situation. The first thing I would have to figure out is what type of account am I going to open up? So if I'm wanting tax breaks, the easiest kind of account is a SEP IRA in terms of a small business. Now and you can contribute more. It depends on your income, but you can contribute more than a normal IRA. In fact, I'll just show you this. SEP IRA contribution limits. Vanguard. Vanguard's got an article. Look at Vanguard stepping up. You can contribute up to 25% of the employees. I think it's 20%. Yeah, if you're self-employed, your contributions are generally limited to 20%, but it's up to 61 grand in 2022. And these are about as easy to open and deal with as a regular IRA. And you can have your tax accountant actually calculate what your contribution can be. There are other options. You can do a solo 401k. There's more paperwork and can be more expense. So, but there are pros and cons. So you'd want to talk to a tax person to figure out what's best. And then, you pick your portfolio. Again, I think the starting point is a 3-fund portfolio, but you may add to it depending on your approach. And you're ready to go. It's that simple. I don't know what else to say. There you go. That's what I would do. Akeem. So Akeem wants to know, you buy a stock, you're hopeful, you're gung-ho, but it drops by 30%. Do you sell or wait for it to break even? Okay, so first of all, what I hope I'm never going to do is wait for it to break even, because I have no idea if it ever will or when, or right. I mean, it's either a good investment now or it's not. So the first question I'm going to ask is, did I miss something when I evaluated the stock and bought it? Did I miscalculate? Did I not see a risk? Did something happen that I didn't know? And if the answer is yes, then I'm going to reevaluate the company and whether I think it's a good investment at its current price. If it is, I'm going to keep it. Doesn't matter what I paid for it. That's water under the bridge. If it's not, if I missed something, then I don't think it's a good value anymore, then I might sell it. If nothing's changed and my valuation still remains the same, I might buy more. Right? If I thought it was a good deal before it fell by 30%, it's probably a great deal after it falls 30%. One of the rules that I have that I try to live by is that once I buy something, I don't sell it for 2 years. I more or less have stuck with that. I mean, there might be some exceptions, particularly if there's a tax loss situation where I sell it, but then buy something very similar to it. Depends on what it is. I haven't done that in a while. But it avoids, I got this idea from Guy Spear, who runs a fund. I think it avoids, one thing it does is avoid these kinds of questions, unless you bought it more than 2 years ago. Yeah. So anyway, that's how I think about it. I don't really think about, let's wait till we break even. Najib says, would you invest in Amazon considering there will be a stock split soon? Absolutely not. The stock split should have no bearing on, first of all, it's already public. So one could argue it's already been baked into the price, number one. To the extent that, I understand that in the short term, people love stock splits. It's like, I've got a pizza cut in 4 slices, but it's much more valuable to me if you cut it into 8. People think they've got more pizza. I don't know. But it's silly, and long term it has no effect on that. I guess could you say that more people invest in it because it's a lower stock price? Maybe. But it is fun. I like it when companies I own, Apple splits its stock. But I have to remind myself, Rob, you're an idiot. I'm not calling any of you that. I'm saying I call myself that. I'm usually not that harsh. But, you don't own any more of the company. You own the exact same amount of the company. You've just cut your pizza into more pieces. But even if I want to go down the path that, as illogical as it may be, the announcement of a stock split can cause the price of a stock to go up. It's already been announced, right? You're not speculating. Didn't Amazon actually announce? Yeah. 20 for 1. I didn't know it was 20 for 1. Buy. No, it's already baked in. And then didn't they have earnings and people weren't happy with it and their stock didn't crater exactly, but I think it had a bad day, didn't it? I track it a little bit. Where is Amazon? I thought I did. Maybe I don't. AMZN, right? It's down. Year to date, it's down big time. Started the year at 3,400. It's down 1,000 points? Really? Wow. Yeah. Still has a PE of 38. Not that that by itself tells you anything. Anyway, so yeah, I would not buy it because there's going to be a stock split soon. I think that's not a good reason to buy, in my humble opinion. Well, it's 8:30. Let me find one more. Kevin says, Rob, I hit the like button. Thank you. I answered this one, a similar question. I think so, Steve. I think IBonds are still a good deal. I'm going to try to find one more question. Hi from Cincinnati. Ann, welcome. I like Cincinnati. It's a good sitcom based in Cincinnati. You guys remember that one? I'm showing my age. What is the name of the fee-only fiduciary you mentioned? Mark Zoril, Z-O-R-I-L, of Plan Vision. Sala. Hi, Rob. Thanks for the videos. Oh, from Chile. Nice. What would happen to the stock market if every investor invests through a passive ETF? Well, it's funny you asked that question because Charlie Munger alluded to that. And his comment was if 90% of the market was owned through passive index funds, the market would cease to function properly. There's no price discovery. But at least at present, there's no risk of that. I know I said one more, but I'm finding some good questions. Brett, why do most fund managers struggle to beat the market when they are well educated, smart, and work hard to achieve just that? So here's my theory. There's a couple of reasons. First of all, they have to beat the market by more than the fees that they charge. So if they're charging 1%, they can't just beat the market. They got to beat it by 1%, and then they just break even. So that's the first problem. Second problem is they have a lot of money to invest. Most funds, you hundreds of millions, billions. That was part of the problem I think Cathie Wood had. She was too good for a while, and then she had all this money to invest. I feel confident investing the money I have. If someone said, Rob, here's 500 million, go invest. It's really hard to beat the market when you've got a lot of money to invest. And when a fund has some success, I'll define it as beating the market, say, for a year or two or whatever, then they tend to have a lot of money to invest, and it's hard to do. And then, you have to kind of keep investors happy. And we're a very impatient lot, or many are. I think it's actually one of the advantages if you're not impatient. But, they want to see results. And so in most cases, if a fund starts to lag, it can be a death spiral. So that's why I think I have a better chance of beating the market than most actively managed funds, even though I surely don't know as much as they do, and certainly don't have the resources that they have. But they have all of these problems. So in my view, that's the problem. I calculated intrinsic value when I first bought Apple in 2013, Gary. More recently, I try to find stocks that I think are so undervalued I don't need to calculate anything, which was the case with Bank of America in October of 2020 and Wells Fargo in January of 21. I looked at their book value, their price to book, the balance sheet. To me, they were just well undervalued. I didn't do a spreadsheet. I didn't have a template. Yeah. All right. I really do need to go. I was trying to find maybe a non-financial question. Here's someone from Hawaii. Welcome. You make me smile. Kevin, you are still talking to nobody. Yeah, probably true. All right. I wish I could get to all these questions, but I just can't. Where's VJ, by the way? From Michigan. I don't think he's missed it. He's not here. So, Steve, I reached out to Kitces. This was before the YouTube channel. This might have been for the podcast. And we were going to do something and we just didn't. I should reach out to him again. All right, so I do have to call it a night. I will say, on a non-finance question, I've been watching a show that I like. So I guess it's, hang on. Where? I'm going to show you the show. Ah, here it is. I guess it's called Slow Horses. Slough House is the reference, but in any event, I would take that comment off, but I'd have to find it again, and I've lost it. What did I do? There it is. I've been watching this. Really good. I've enjoyed it. Anyway, that's all I got. So it's been a lot of fun. Appreciate everyone watching. I'm sorry, I know I don't get to all the questions. I do the best I can. I do have more videos planned out. This WKRP, absolutely. That was the answer. Great show. Anyway, I do have more videos planned this week. So look for those. You can subscribe to the newsletter below the video. And that's all I got. So have a great week. And until next time, remember, the best thing money can buy, financial freedom.